Hello, this is Michael Loftus for Weekend Wisdom. Today we're going to talk about, does it make sense to add individual equities to your diversified portfolio? So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV. So again, today we're going to talk about, does it make sense to add individual holdings to your diversified portfolio? So why do you want to talk about this? Well, there was an article that came out a couple weeks ago by a gentleman by the name of Josh Brown. You may have seen Josh before. He's big on Twitter. He does the CNBC halftime show and some other things. You know, very quirky on Twitter, very edgy, very opinionated. This is not a fight against Josh. This is not a diss tape. It's just a disagreement on what he wrote about in his blog and also talked about on CNBC, the single stock Mishegas. Now, what he said here was basically advisors like myself should not be adding individual holdings to client portfolios. Why? Well, because you may not have the experience, you don't have the time. It's impossible to track all the different positions. What if you have family members and one person has this, one person has that? So several different reasons. We've got a link to this article below. So the question is, does it actually make sense? And to me, it comes down to, yes, it does. I think he's completely wrong. This is why people hire us, quite frankly. And I'll get more into this in my closing thoughts, but, you know, most importantly, it comes down to, what are the facts? Okay? So what I've done is I've put together 3 hypothetical portfolios year to date. I did a 60-40 S&P bonds, 60-40 diversified portfolio of indexes, bonds, okay? And then I did also a 60-40 diversified and added 3 big tech names, 3 random big tech names, okay? Now understand, this may not work in every market, right? A couple years ago it was about the FANGs. Last year was value, but although you could add some value names. And this year, again, back to the big tech names and momentum. So I think if you have an opportunity to capture it, there is a potential for some upside. So let's see what the facts tell us. First off, year-to-date through last Thursday, the 60-40 portfolio is up 8.83%. All right, max drawdown, how much has it gone down? 0.86. And beta, beta's risk. If you have a 1 beta, that means you have the same amount of risk as the index that you're comparing to, in this case, the S&P. So makes sense, 60-40, you should have about 40% less risk in the portfolio, capturing 40% less of the S&P, or capturing only 60%, depending on how you look at it. So pretty decent, pretty much right in line year to date. So let's take a look at the diversified portfolio. Several different asset classes, and I've got information below and disclosures at the end that will discuss all of this. So what do we see? 1, a little bit better performance, 9.64. Max drawdown, 1.4, so a little bit more on the drawdown side this year. Beta risk, though, only at 0.63, so seems worth it when you take a look there. So our final portfolio is going to be the diversified portfolio, but I added in 3 tech names, big tech names. So year-to-date, 11.43. Year-to-date through last Thursday. Max drawdown, 1.3, actually less than the diversified portfolio, more than a 60-40. And risk goes to 0.64, so we went from 0.62 to 0.64 on risk, and able to capture almost 3% additional return by adding in individual equity. So if you take a look at the combined, here you go, right? The numbers, the facts tell me that if you spend a little bit of extra time, you could have an opportunity to add some additional alpha. Alpha being return to your client's portfolio seems to make a little bit of sense to me. So let's get to another one of his points. And here he talked about, individual stocks, when to get in, how do you add it when one family owners own this and that and all this other stuff. So here's a hypothetical situation. I just picked a random tech stock, put it in here, and, where's your entry point? Well, I mean, if you're looking at the charts, the technicals, there's a lot of different entry points. Happen to add this at the beginning of the year if you look, and you see year-to-date up 108% through last Thursday, this particular stock, okay, in a hypothetical situation. Well, the year goes on, and hypothetically another client comes in. Well, does it make sense to add this big tech name? Well, again, it depends. Look at the market, you look at the charts, you do your due diligence, and you say, yeah, you know what? We had a nice breakout, momentum's still there, it's underpriced, earnings look good, whatever the case might be. However you identify and look at stocks, you might see a little bit of a pullback, and then you get in. Good decision. Is one client happier than the other? Well, look, everyone has different objectives, right? The objective for our retirees are 3 to 6%. Right? Doesn't mean we're going to get that every year. This year, obviously, you have a different return because of what's happening. But when you look at where you are, is that person that got added at the end of the year unhappy with their return? I'd say no, because we added that additional alpha. So, closing thoughts. Well, the other thing is he talks about bringing in outside managers. I'm just not for this. Personally, this is why people hire me. We're a boutique firm. I understand our industry is focused on more. More clients, more assets, more. But with more is less hands-on experience. So we choose to do this type of work. The other thing is, if you're going to bring in an outside manager, you got managers managing the managers. And that means fees on fees. I think that is a takeaway from the overall performance. So I don't like that idea. So you have to be careful there. The other thing is, and I thought this was funny, this was an article I saw at Advisor Hub, an industry journal, but it said independent brokers who outsource are often less productive. Now, I'm not saying that Joss is less productive. I see him everywhere. He's definitely a hustler, but the firms that have notably lower assets under management per total practice headcount compare with those who build custom portfolios or models. So basically, those who do it themselves seem to do better. So I think that's very interesting. So again, we're closing this out here. I believe it's why you hire somebody. I tell our clients when they come on, I work for you. And if it means finding alpha, you got to find it wherever it is in the market, whether you're long, you're short, you're hedged, you're cash, whatever the case might be. And every individual is just that, an individual, and it's our job to help them achieve their goals. Thanks so much for watching. Michael Loftus, Loftus Wealth Strategies, and Wealth and Wisdom TV.